The future is uncertain, but knowledge is power. Jim Rickards, the economic expert who predicted the last financial crisis, is back with a warning we can't afford to ignore. These signs are everywhere, markets on edge, uncertainty looming, and a crash that could reshape everything we know about the US economy. In this video, we'll break down Rickards' insights on what's coming, how it will affect you, and most importantly, what you can do to prepare. Stay tuned, this is one video you won't want to miss. Jim Rickards, a respected economist and financial commentator, frequently warns about potential economic downturns and their far-reaching effects. When he mentions a US crash, he's usually referring to a major financial crisis that could deeply disrupt the American economy. Rickards believes that such a crash could have serious consequences, impacting everything from stock markets to everyday life. His insights are a call to be prepared for economic shifts that could shake the foundations of financial stability, urging people to think about how they might protect themselves in uncertain times. A significant economic crash can create widespread instability that touches nearly every aspect of daily life. Businesses, both big and small, may struggle to stay afloat, leading to closures that ripple through communities. This kind of instability doesn't just affect employment, it also shakes consumer confidence. People may become hesitant to spend money, worried about what the future holds. As a result, the entire economy can slow down drastically, stores see fewer customers, investments dry up, and the overall economic activity grinds to a near halt. In such a scenario, the effects can snowball, creating a cycle that's hard to break. Job losses lead to reduced spending, which causes more businesses to suffer, leading to even more layoffs. The sense of security that people once felt about their finances and jobs begins to erode, replaced by uncertainty and fear. This kind of environment can make it challenging for the economy to recover as both businesses and consumers become more cautious, further slowing down economic growth. A major crash doesn't just cause a temporary downturn, it can lead to long-lasting economic instability that affects everyone, from employees and business owners to families and communities. The aftermath can be felt for years as the economy struggles to regain its footing and restore the confidence that was lost. During such a crash, panic can set in, leading to massive sell-offs as investors rush to protect what's left of their wealth. When everyone starts selling at once, the value of stocks can plummet, wiping out significant amounts of money in a short period. For many people, this could mean watching their hard-earned savings evaporate almost overnight. This kind of volatility doesn't just affect professional investors, it has a profound impact on ordinary people too. Think of all the retirement savings, college funds, and nest eggs that are tied up in the stock market. A sudden downturn could mean that years of careful saving and investing lose much of their value. The ripple effects can be staggering. As wealth disappears, consumer spending declines, which in turn hurts businesses, leading to more layoffs and further economic strain. Those nearing retirement might have to rethink their plans, possibly delaying retirement or cutting back on their expected lifestyle. Younger investors could become disillusioned with the idea of investing altogether, which could slow down future economic growth. Volatile environment, financial markets can become a roller coaster of fear and uncertainty, making it difficult for anyone to plan for the future. The losses could be long-lasting, and the path to recovery might be slow and painful, affecting not just individual investors, but the entire economy. Jim Rickards frequently cautions about the potential devaluation of the US dollar during a major economic crash. If the dollar loses its value, it could trigger higher inflation, a situation where the prices of goods and services rise rapidly. That's inflation in action, and it can make everyday life significantly more expensive. Things like groceries, gas, and utilities could all see price hikes, leaving you with less money to cover your essential needs. Inflation doesn't just affect your wallet, it can also erode the value of your savings. Money that you've set aside for the future might not stretch as far as you'd planned because it simply won't buy as much as it used to. This could make it harder to save for big goals, like buying a house or retiring comfortably. For people on fixed incomes like retirees, inflation can be particularly tough. If prices keep rising, but their income stays the same, they'll find it increasingly difficult to maintain their standard of living. The everyday things we take for granted, like affording food, gas, or even a night out, could become luxuries. Inflation caused by a weakened dollar can have a profound impact on everybody, making it harder to make ends meet and plan for the future. Rickards' warning is a reminder of how deeply an economic crash can affect not just the big picture, but the day-to-day lives of ordinary people. In the face of a major economic crisis, the government could be forced to take drastic action to try and stabilize the situation. These measures might include tightening regulations on financial markets, adjusting interest rates, or even introducing new forms of currency or financial controls. The government stepped in to manage the chaos. Suddenly, there are more rules and restrictions on how banks and financial institutions operate. These new regulations could be designed to prevent further instability, but they might also make it harder for businesses to access credit or for investors to trade freely. The government might also change interest rates in an attempt to control the economy. Lowering rates could encourage borrowing and spending to stimulate growth, but it could also lead to inflation if too much money floods the economy. On the other hand, raising rates to combat inflation might make loans more expensive, slowing down the economy even further. In more extreme cases, the government could introduce new forms of currency or impose financial controls to stabilize the economy. This might involve limiting how much money people can withdraw from banks or controlling how currency is exchanged. Such measures could create uncertainty and confusion as people try to navigate the new financial landscape. These government responses, while intended to restore order, could have far-reaching effects on everyday life. Businesses might struggle to adapt to new regulations, and individuals could face challenges in managing their finances under stricter controls. The goal would be to prevent a complete economic collapse, but the road to recovery could be bumpy, with significant changes to how the economy and financial systems function. A major economic crash in the US wouldn't just stay within its borders, it would send shockwaves around the world. The US is deeply connected to the global economy, and what happens here can ripple across continents, affecting countries far and wide. When the US economy stumbles, it can drag down other economies that are closely linked to it. Think of countries that heavily rely on trading with the US. Their businesses depend on American consumers buying their products. If a crash causes US demand to plummet, these countries could see their own economies slow down as exports dry up. Financial markets around the globe would likely react too. Stock markets in Europe, Asia, and beyond could experience sharp declines as investors panic, leading to a loss of wealth not just in the US but worldwide. The interconnectedness of global finance means that trouble in one major economy can quickly spread to others. Currency markets could also be thrown into turmoil, and if the US dollar weakens significantly, it could disrupt international trade, as many global transactions are conducted in dollars. Countries with large reserves of US dollars might find their holdings worth less, causing financial strain. Moreover, a US crash could trigger a chain reaction in other economies. Countries that rely on American investment might see capital flow out as investors seek safe havens, leading to instability in those nations as well. The result could be a worldwide economic slowdown where growth stalls and unemployment rises across the globe. In such a scenario, no country would be completely insulated from the effects. The global economy is like a web, with the US at the center, and when one strand shakes, the whole structure feels it. This interconnectedness means that a crisis in the US has the potential to spark a global economic downturn affecting everyone, everywhere. A major economic crisis could shake up how we think about and manage our money, potentially leading to a significant shift in economic models. When a crash exposes the vulnerabilities of the current system, it forces everyone, from policymakers to everyday people, to rethink how the economy should work. One possible outcome could be a move toward more conservative financial practices. The crisis might highlight the risks of excessive debt and speculation, leading to stricter regulations and a greater emphasis on stability over rapid growth. Banks, businesses, and even individuals might become more cautious, focusing on saving and minimizing risk rather than chasing high returns. Economic resilience could also become a top priority. The crisis would reveal the importance of building systems that can withstand shocks without collapsing. This might mean creating stronger safety nets for people affected by economic downturns, encouraging sustainable business practices, and investing in sectors that are less vulnerable to economic fluctuations. Additionally, there could be a shift away from reliance on traditional financial systems. The crisis might accelerate the adoption of alternative financial models such as decentralized finance or digital currencies which operate outside of traditional banks and governments. People might start exploring new ways to save, invest, and trade that are less tied to the traditional economic structures that failed during the crash. Major crises could lead to a fundamental reevaluation of how we manage our economies. It might push us toward more cautious, resilient, and innovative financial practices, setting the stage for a new era of economic thinking that prioritizes long-term stability and adaptability over short-term gains. Rickards suggests that understanding these potential outcomes is crucial for individuals and businesses to prepare and protect themselves in the event of such a crash. What are your views? Let us know in the comment section below, and don't forget to like, share, and subscribe to our channel.